Good morning, guys. This is the 20th Morgan Stanley Summit, which is happening right now in Mumbai, and the day two. We are joined by Jonathan Garner, Head of Asia Emerging Market Strategist, with us this morning. Jonathan, good morning. Thank you very much for chatting with ET now. Let me start by understanding your views on the valuations of Asian emerging markets and how India stacks in comparison to that, because lately we've been starting getting voices that perhaps the valuations, despite the correction of India versus other emerging markets, haven't really become very attractive yet.
Yes, I would agree that valuations across Asia are not truly cheap. If you go back to the end of January when the market peaked, the broad Asia emerging market indices were trading above 14 times forward PE, so that's above the 90th percentile of their historical range. And though that PE multiple's come down, it's still well above long-run average. And vis-a-vis India, India typically trades at a premium to other markets in Asia because it has higher return on equity. That premium is at a fairly normal level. It's about a 30% valuation premium to Asia overall.
We've been witnessing for the last couple of weeks, emerging markets have been having a rough patch. India has seen its own share of correction, almost 10% from the top, broader markets slightly more. But there are some signs emerging, according to some strategists, that MSCI emerging markets is ripe for some kind of a rebound. Do you concur with that view, and or would it change your overall view in emerging market, or would it just be a tactical rebound?
Well, our strategic view is exactly what it was last November when we began to outline the thesis of what we called a rougher ride for emerging markets this year. So that thesis looked at those high valuations I mentioned earlier, but also that the earnings estimates themselves were too high. It also looked at the fact that we thought the oil price would go up, which it has, which is always a drag on performance for Asian markets. It looked at the tightening of policy in China and the US that's still ongoing. And then, of course, we've had trade protectionism as an additional risk factor. So in relation to a tactical bounce, yes, the market's about 3% below our target price. And so we can maybe get a small rally here, particularly as the dollar has stopped going up in the last few trading sessions and the oil price has softened a bit. But we do think the oil price actually comes back as a headwind into 2019. So we'd be very cautious about strategically re-engaging here. And we do think the end of January was a major market top.
Jonathan, when you interact with your clients in Asia who run money in emerging markets, including big India pieces, what are you gathering about their stance in India? Because last 8 months have been particularly weak for flows from FI side into India. But this Indian market have held on thanks to domestic flows.
Yes.
I want to understand, in 2013-14, FI flows were healthy. Why exactly are they shying away now?
Well, at that period, back 2014-15, we ended up with India being by far the heaviest overweight for global emerging market portfolio managers. At one point, they were actually double weighted versus the benchmark, which is very unusual. Now they're about 200 basis points overweight, and that's at the low end of the historical range. So why have they disengaged somewhat from being so heavily weighted? That's, I think, to do in the main with the fact that we've had quite a depressed earnings cycle here. So even last year, when earnings broadly in emerging markets were up almost 30% year on year, you didn't really have that earnings recovery. And that's a complex story as to why that's happened in India, but it's got quite a bit to do with, I think, a very much needed fiscal adjustment that brought down inflation. But it's also got to do with the temporary effects of structural reforms like GST and demonetization. But now, actually, we are forecasting earnings to pick up substantially, probably 20% plus each of the next 2 years. That's what our research team here in Mumbai thinks. So that's quite interesting because it actually leaves India earnings likely to accelerate at a time when the rest of emerging markets may be decelerating. So we are overweight India, and the clients, I think, are probably going to stop reducing their positioning now that they are at a low overweight compared to where they typically are.
And if that hypothesis which you are making does play out, India earnings accelerate more compared to the other emerging market peers, how do you think the market would move? Because the market has done well 2.5 years despite a lack of earnings. And now if earnings come back, is there a case for a further acceleration?
Well, I mentioned earlier that in terms of forward PE, in the Indian market's probably appropriately priced. So we don't have a particularly aggressive Sensex target. It's 36,000. So we get a like modest upside in dollar terms versus what we're seeing in broad EM, and certainly versus some of the markets we're underweight on. And so that is a reason to be constructive. I think on the local to local flows, it's very important here in India that we don't get an acceleration in inflation and that we don't get any significant further increase in 10-year bond yields. India does retain vulnerabilities in terms of current account deficit and exposure to oil. So again, that's a risk factor that would otherwise, would hold us back a bit versus otherwise being more bullish on the earnings side.
The other thing I want to understand from you is when you analyze an emerging market, economy plus market put together, how does the structure of India look to you right now? There was a time when it was part of the fragile five. Do you think now it's becoming relatively more robust, and how do you see it fare from the next 1 or 2 years?
One of the most important things is to think about the different sectors that make the market up and how much of the market is actually truly geared to the domestic economy, which would be sectors that are large here in India, say like banks or domestic cyclicals and capital goods. And then how many are actually in the export group and depend more on global factors, global demand, and then the value of the currency. And here you have two big sectors, pharmaceuticals, and software in terms of the IT services names. Of those two, we actually much prefer the IT services at the moment over pharma. But if you look at the domestic story and that earnings recovery that we're expecting, that's linked to a GDP acceleration that we can already see is ongoing. And that definitely puts us in the bullish camp on India. But then in relation to current account deficit, it's much less than it was in 2013. It's sub 2%, whereas some other EM countries haven't really made such a big adjustment. But India is still not in the group of countries that runs a large surplus, like, for example, Singapore or Taiwan or Korea or Thailand. So in that sense, it is still somewhat more vulnerable than other parts of Asia.
If one were to analyze the way the composition of the sectors in India have been, the oil sector, for example, had a very rough time last couple of weeks, not been able to pass on the price adjustment. At the same time, autos have done very well, the numbers are robust. Financials, again, a divided lot. Yes. And IT and pharma have lagged the overall market. How are you looking at the big ones, the big sectors, and what's your stance on some of the ones? Which ones do you like and which ones will stay away from?
Overall, we're more in the domestic sectors. That's my view, and also that of Ridham and the team here. Because of that domestic economic acceleration, the banking sector reform, the recapitalization of the public sector banks is important, structural reform. And when we look at things like you mentioned autos, the two-wheeler sales and the auto sales generally are picking up, and we've written about that quite extensively. And we also seem to be at the beginning of a genuine sort of capex cycle that will benefit the large capital goods names here in India. So that's the core of the portfolio for us.
Mm-hmm. And how do you rate, because FIIs do rate political leadership as one of the factors for which the economy and the market would accelerate. What are you gathering right now? Mr. Modi is just finishing 4 years in office. Out of the work done so far, how would you analyze the performance?
We certainly include that as part of our country process, along with many of the other things we've just been talking about. I think the main thing from a foreign investor perspective is that whoever is in charge of India, that we actually maintain this recently achieved fiscal discipline and low inflation. And that's really important for the development of the financial sector. And it also helps economic development more generally. So I think that's a key thing that we will be watching in that regard. Other than that, I don't have any specific comments on next year's election.
Sure. All right, Jonathan, we'll let you go on that one. Thank you so much for your time this morning.
Thanks for having me.